Good day, ladies and gentlemen, and welcome to our class on Fibonacci retracements and how to use Fibonacci's to find retracement points, turning points, and buy and sell points. Now, Fibonacci retracements are ratios used to identify potential reversal levels. These ratios are found in the Fibonacci sequence. The most popular Fibonacci retracements are 61.8, 38.2. Now note that 38.2 is often rounded out to 38 and 61.8 is to 62 because Fibonacci's are not precise exact numbers, they are levels. Now also keep in mind that 50% is a very popular retracement, and it's been kind of in the online trading world thought of or added into Fibonacci's and in the Fibonacci tool, but 50% has nothing to do with Fibonacci levels. 50% comes from Dow theory developed by Charles Dow, but it is a very popular retracement level. Now, we're not going to delve deep into the mathematics and the golden ratio and the Fibonacci sequence, but we're going to take a look at where these numbers come from, because we have to understand where they come from and how they convert over to our ratios. Now, these ratios come from the sequence, okay? And the sequence, from somebody told me back when I was in school, and that was a long time ago, that it started out by watching bunnies multiply. And you start out with a 0. And then, of course, the next number is a 1. You add 0 and 1 together, and what do you get is 1. We add 1 and 1 together, the two left-hand numbers, and we get 2. Then we add the 1 and the 2 together, we get 3. We add the 2 and the 3 together, we get 5, and so on and so forth. And the sequence extends into infinity and contains many unique mathematical properties. But now, how does that become a ratio? It's easy to have 0, 1, 1, 2, 3, 5, and the numbers never change. You don't have one set of numbers and somebody else over there has another set of Fibonacci numbers, or the Fibonacci sequence is a permanent set of numbers. And so is the ratio. But we get this ratio by multiplying or dividing the previous number by the current number. So in other words, we have 1 plus 2 equals 3. So then we have 2 plus 3 equals 5. 3 plus 5 equals 8. 5 plus 8 equals 13, and so on and so on and so on. Okay, that's how we got them. Now, if we were to take a number and divide it by the previous number. So in other words, when we get up to 8 plus 13, we get 21. If we were to take that 21 and divide it by the previous number 13, it would always give us 1.61. If we were to go up the next ratio, the next sequence, with 34 divided by 21, it would give us 1.61. Go on and on and on. And so the approximation is at 1.618. And that's why I said it's not an exact precise number, it is a level. So we use the level of 1.618. Now this is actually what we consider a Fibonacci extension, because it's beyond the 1. But then if we were to go and take and invert what we just did, and instead of taking the 21 and dividing it by 13, we were to take the 13 and divide it by 21, it would give us 0.619. We would go to the next step, 21 by 34, 6176. 34 by 55, 618. 55 by 89, 6179. And this is where we get the 0.618, or the 61.8% retracement level. We go to the next level, and we were to take that 13 and divide it by two numbers over. Now, remember, these numbers are constant. It's 0, 1, 1, 2, 3, 5. So all you're doing is, and as long as you're doing them exactly the same, so first you're taking the number you have here and dividing it by the previous number. Okay. Now we're going to go take that number we have here and divide it by two numbers back. And when we do that, we get 38.2, which is another Fibonacci retracement level. If we go back 3 levels, and divide the 13 by 55, which is 3 levels forward, we would get 2163. And this gives us our Fibonacci retracement levels: 61.618, 618, 0.382, 0.236. Now, the funny part is these numbers appear not, their numbers didn't come up for financial markets. It's not got anything to do with online trading. These numbers have been around forever. Now, 1.618, which is the first number we got, which is when we divided the current number by the previous number, is known as the golden rule or the golden mean. It's also called phi. And the inverse of phi is 0.618. And these ratios can be found throughout nature, science, and art. In fact, it is said that the closer your eyes, ears, and nose and your mouth are to these numbers, the more attractive a person tends to be. And when you take a very attractive person, divide down the differences, you'll find that these numbers hold true all the time. And we find these, it's what the Greeks used to build the Parthenon. Sunflowers, in those little circles in a snail shell, in the spirals of the galaxy, we find that these numbers hold true. And like I said, these numbers were never developed for the financial markets. But when we see an asset, a security, a stock, a currency, a commodity, climbing up and making an uptrend, it will push up a certain level and then it will ease back down. Now, these eases, if you learned about trending, are very important in the life of a trend. It's a push and ease, a push and ease, a push and ease. And these are actually established by prices moving up, and at some point it triggers sell orders, because a lot of buyers, when they bought, I'd already put in a pre-sell order at a specific level because they're happy to take their profit. Okay? They're not watching the stocks and the charts all the time, and their system closes their order. There's also the other set of buyers who are buying, but now they're saying the price is a wee bit too high. We're going to sit on the sideline. And the price eases back down. When it eases down, it will ease down to 38.2. Now, it can turn around and move back up there and continue its uptrend, or it might move down as low as 50% of the previous up move, or as steep as 61.8, and then move back and continue its trend up. But we found statistically that it's at one of these three levels that price tends to move back upward. So the picture shows a graphical representation of the reversal points for an asset in an uptrend. The pattern is reversed when the assets are in a downtrend. So remember, everything for this is mirror image, uptrend, downtrend. So in order to find these Fibonacci retracements, you have to find the most recent significant swing high and swing low. Significant is important. It's not the lowest point it ever reached. It's the significant. Sometimes weird things happen in the market, and you can get a very, very, very low because it was just a freak accident of nature. You need to find something that was significant, either 2 consecutive swing lows, 2 candles closing at the same price, something that says this was the turning point. Then for a downtrend, you want to click on the swing high and pull your retracement tool to the down to the current swing low. And for uptrends, you want to do the exact opposite. Now, the belief here is that an asset will retrace a certain period of a certain portion of its previous move. So let's go take a look at a stock chart, a real chart, a live chart. Okay, so what we're looking at is we're looking at a gold US dollar chart right now. And we can see that gold made a swing low. Let me just get my marker on here. Right here. See how significant that was? Even if we had a little low here, that was not the swing low. This is the swing low here. Okay. Let's get my marker off here. Why won't my marker turn off? Okay. Well, give me a second here because for some reason this marker doesn't want to turn off. Let's see if we can do it this way. Okay, now we've identified the swing high and the swing low. So we go over here to our and locate our Fibonacci retracement tool, and we take it to our swing low, and we pull it all the way up to our swing high. Now our swing high is here. It's the highest point it moved in this uptrend. We then extend it forward, and we don't have to do this. Our chart will do it automatically for us. And we now have our Fibonacci retracement levels. Now, these retracement levels are if price dips back down. Okay? Because we're saying at this point we believe the trend has ended. Okay? So now it's going into reversal trend. Push, high, push, high, push, high. So we would expect a retracement to happen at this level. And if it falls down farther, this level and this level, which are our 50%, our 38.2, our 23.6, our 50%, and our 78.6. And this is all the way down to where that trend began. So we can see that I've already put it on this chart, and you can see here price had moved down. Now you can't see. Okay, well, actually, that's get my marker back on here. So this was the uptrend. This was the very end of that uptrend, and now we've moved to a downtrend. Okay. You can see the retracement levels here. And the nice thing when we see these is look how well these retracement levels coordinated with swing highs and swing lows of the uptrend. So now we would expect as price moves down here. Now look what happened now. What happened was when price hit this fib level, oh come on tool, that it was significantly stopped. When it hit the 50 level, look how well it stopped. And when it came all the way down here to the 61.8, it bounced off, and now we're expecting it to continue its uptrend move back to move, not to regain its uptrend, it's making a retracement in its downtrend. But it's given us these key support and resistance levels. And when these Fibonacci levels tie back to our other uses of support and resistance, it also helps us give double weight to those levels. So let's go back to my PowerPoint. So now that you know how to draw them on, so what we're looking for is in a strong upward move, the swing high, we would then pull our Fibonacci level from our swing low to our swing high, or the exact reverse when we're ending, and it's the previous trend, not the current trend you're in. It is the trend that has ended, because the basis of it is that price will retrace a particular amount of its previous move.
Take a look at Fibonacci in the real world. What we're looking at is gold. So I'm going to do a couple of historical examples to show how it might have worked, and then a current example on gold. So let's pretend it's the end of February, so we're here. We've watched gold go from these December lows around about $1,120 an ounce, up as high as here, up as high as sort of 1260 area recently. And it starts to come off. So we think, right, I'm going to use my Fibonacci retracements to try and figure out where the price of gold might stop sliding and bounce and continue this trend. So let's put the retracements on. So we pick them up from here. We start at the beginning of the move. So I click down there and then drag it all the way up to the high, and it puts the retracements on for me. Let me just adjust this one down here. There we go, that's better. Like a lot of software, it does include some additional Fibonacci levels, but the main ones I'm worried about, let me just make this a bit clearer. I'll right click, change the color, make the lines a bit thicker. Here we go. So what I'm looking at is the 23.6, the 38.2, the 50 and the 61.8. So if the Fibonacci is going to work, the market's gone up, and then we're looking to see if these levels, the 23.6, the 38.2, the 50 and the 61.8, do they support the market? Let's just walk through and see what happens next. So these are daily candles, don't forget. So the market's selling off. So we're on the 23.6 level now. That's broken, it's gone through that. So the next one to watch for support is the 38.2 at 12.09. That's gone again. We can see it breaking through. And the next level we're looking at is 50%. So the market's gone from here up to there. And now if it gets to this level, it's dropped back 50%. That's our next Fibonacci level. So let's just push it forward. And actually, it looks like it's working. So the market went from X to Y, dropped back 50%, and the market has recovered. Let's have a look at the next rise. What happened next after this? The market did push higher up to here, just back up near that old high and started coming off again. So again, let's, as usual, let's just adjust our lines. So we'll pick it off that high there. And again, we're just trying to see now what happens. Does the market hold on these old levels? I think it's pushed just a little bit higher. So let's just nudge it up to that high up there. There we go. And it started coming off. So our 23.6% level is at 12.54 an ounce on gold. Then we've got 12.28.5. That's our 38% retracement. And then the 50% is there at 12.08. And then the 61.8% is there at 11.87. So let's just walk through and see what happens next. The market's sliding. So it's taking out that 23.6% level. So 38.2, that's the next level to watch. It's taken that out. But so far it's holding, and once again the 50% retracement level has worked. So it took out the first two Fibonacci levels, but the market did move higher again. Okay, so now this is an up-to-date chart for gold up until the end of last week. So the market had pushed higher beginning of June, sold off. Let's put our Fibonacci levels on. Let's take them again. Let's take them again from the start, from down here. So from those lows in December up to the most recent high, beginning of June. Again, I'll right click, make this a different color so we can see it. There we go. So the market slid off, has slid below 23.6. At the moment, it is holding above that 38.2% retracement at 12.30-ish level. And if that level breaks, the 50% one to watch out for is 12.10. So there might be a couple of levels. If you're a fan of Fibonacci,
to start using these fibs in some type of decision-making capabilities. Now, in order to apply Fibonacci levels to your charts, you'll need to identify the swing high and swing low, which I've just shown you over. But it's important. A swing high is a candlestick with at least two lower highs on both left and right side. Okay? This is a finite decision, but it really isn't. Remember what I told you earlier, significant. So when using the Fibonacci tool, the probability of forex trading success could increase when used with other support and resistance levels, trend lines, and candlestick patterns for spotting entry and exit points. So think of these as alert zones. Retracement levels alert traders or investors of a potential trend reversal, resistance area, or support area. Retracements are based on the prior move. A bounce is expected to retrace a portion of the prior decline, while a correction is expected to retrace a portion of the previous low. Keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for a potential reversal. This is the point that all traders should employ other aspects of technical analysis to identify or confirm a reversal. So now we want to talk about how we might want to use these fib retracements in our trading. So we want to use our fibs to find exit points, entry points, and stop loss points. They will give us all of that. So using the fib stop loss approach is especially interesting because it offers a more objective way of placing your stops. Many people place their stops based on prior swing lows and swing highs. Some based on how much of a difference when it broke the candlestick broke, or when it broke out of a pattern. Fibonacci uses the next level or the previous level and sets the entry or the stop loss point slightly above or below that point, depending on which way it's going. So once a trade is drawn as Fibonacci levels, they don't move anymore, and the potential stop loss is well defined. So now we need to know how to figure our entry or an exit points. So how to use a Fibonacci retracement to enter a trade, and how to use it to set the exit point. When you are placing an exit order, it's a good idea to place it just before the level you plan to exit. You should practice it yourself, but my advice is to place exit orders a few points either earlier than the next exit level. Sometimes the price will not touch the extension line, like in the previous examples. It may miss it just by a few points. So it will still be a valid move to the Fibonacci extension. Exiting a trade is very important, yet it is not so easy. We want to exit at the very best moment. So again, I've got a little preparation set up for you. So let's watch that, and we're going to explain all of how you would set your buy, your entry points for using Fibonacci levels. So this is using a triple fib strategy and the 78.6, which is a much overlooked Fibonacci retracement level. But imagine yourself in a store and a salesperson says suddenly, all of the goods available are at a 78.6 discount. Guess what? The buyer steps up at least at some point. The same principle can be used in the world of forex trading. The simple market psychology is valid because a 78.6 is farther than the 31.8, the 50, and the 61.8. So when we get to 78.6, we're either in a complete reversal or we're in a retrend where it is a very good buy price. So there's a lot of importance to the 78.6 level. So let's watch this little presentation, and hopefully by the end you'll understand how to use fibs,
that we see,
the value of
terrible
78.6,
drawing of these
and
candles,
you've got a beginning
we see
starting
that the
point
market came up,
for adding Fibonacci
retraced
retracements into your
down to the
trading
swing
plan.
low, and then we broke above the most previous structure level here. And since we broke above and closed above this most previous resistance level, our expectation would be a continuation of bullish momentum, a continuation to the upside, before a break below the most previous swing low right here. So what we expect this market to do is to go up further before it comes down and breaks below this most previous swing low. And the way we take advantage of this using this trading strategy is after we get a break above, close above the most previous resistance level right here. After we get a break above, close above this level, we take a Fibonacci retracement from our swing low right here up to the highest swing high before the market starts to retrace. And all we do is wait for a 786 retracement. As I said before, very, very simple, yet very, very effective strategy. The reason we wait for this 786 retracement is because we expect the market to continue bullish before breaking below this swing low. So what that means is if we wait for a 786 retracement, we can put our targets back up at previous structure because we expect the continuation of the bullish trend, and we can put stops down here below the most previous swing low, just in case we're wrong, because if we are, we want to get out for minimum losses if we're wrong, and we have an opportunity for a very nice gain. And I hope that makes sense. If it doesn't, then leave me a comment and ask any questions you might have, and I'll try to answer them best I can in the comment section below this video. I'm going to now go to the charts and show you a few examples on the dollar yen that we took advantage of over the past couple of weeks. And then I will show you a live example of this trading strategy on the Euro Aussie 15-minute chart. Alright, so here we are on the dollar yen, and I'm just going to start right here in a random position on the chart and show you a few examples of the trend continuation 786 strategy. So what we look for first is a break above, close above, or break below, close below of a previous structure level. Here is our previous resistance level. We obviously break above and close above it right here. Since we broke above and closed above that level, what I would do is, if this market had not already played out, if this was all to the left and I had no right into my chart, what I would do in this situation is take a Fibonacci retracement from swing low to swing high and wait for the 786 retracement right here. And as we can see, the market rallied before ever getting close to the 786, which is fine. That will happen a lot. And next off, let's continue on the chart. As you can see, we get another break above, close above this previous resistance level right here. On this candle, we break above, close above this level. So what I would do is take a Fibonacci retracement from this swing low, the most previous swing low here, up to the swing high before we start to really retrace. And as you can see, we came down here to the 786, would have been filled on this order, and we would have hit targets there, coming up to this previous resistance level, which is where our targets would have been, and our stops would have been below our most previous swing low. This would have came down and put us through a little bit of pain on this wick right here, but we would not have got stopped out on that trade. And we just continue down the charts doing this same thing right here, break above, close above this level. So now we're looking at this most previous swing low right here. So we come from this swing low up to the swing high before it starts to retrace. We would have bought the 786 right here on this candle wick, and we would have been stopped out of this trade. But look here, look what happens now. Now we have, instead of breaking again to the upside, now we have broke through this support level, and this support level. What that tells me is bearish rotation. Now that we've broke down below these support levels, I'm in a bearish trend mindset. With that being the case, I'm going to now take a Fibonacci retracement from this swing high down to the swing low and look for my same 786 retracement. As you can see, would have been filled here, and this is a trade we actually took advantage of. We were filled there, and the market eventually rolled over and did hit targets. So I hope that helps you to better understand the 786 strategy. As I said before, leave me a comment if there's something you don't get about this strategy, and I'll try my best to answer it in the comment section below this video. I'll now be showing you a live example on the Euro Aussie 15-minute chart. Okay, so here we are on the Euro Aussie, awaiting the completion of the 786 strategy that I was talking about. And pretty much all we're doing here is waiting for a break below, close below of the previous structure, and then putting a limit order at the 786 Fibonacci retracement, a stop loss above your previous swing high, and profit targets at the lowest body of the previous swing low. And there we go, we're filled, and I will keep you updated on how this trade plays out. And as you can see, guys, we've come up into our 786 retracement here and immediately turned around. We've now made it about halfway to targets, so we'll see how this plays out, and I'll be back to update you. Alright, here we go. So we've gotten within about 5 pips of our targets here, And when we get down here within 3 pips, I'm going to move stop losses to break even so that we can be in a risk-free trade. And hopefully we'll see this market continue down. As you can see, we've made a lower high here. And then we put in a very long bearish candle so far. And this candle has 15 seconds before it closes. If we can get under these lows right here with this candle, then our stop losses can be moved down to break even. So now we've got within 3 pips of our profit here. What I'm going to do is take my stop loss, bring it down here to break even, and take all the risk off the table on this trade. So this is now a risk-free trade.